MFRS 9 Financial Instrument. MFRS 9 replaced the current MFRS 139 and reverses the accounting guidance for classification and measurement of financial assets, impairment, and hedge accounting. New approach for the classification and measurement of financial assets by subjecting the financial assets to the cash flow characteristic and the business model test. The impairment model for financial assets has been changed to one that's forward-looking and based on the expected credit loss. And the new rule for general hedge accounting, which will allow entity to reduce profit or loss volatility. And MFRS 9 established the requirements for recognizing and measuring financial assets, financial liabilities, and some contracts to buy or sell non-financial items. And MFRS 9 also improved the decision usefulness of financial statement and adopt an entirely new principle-based approach to classify and measure financial assets. To determine the classification and the measurement of financial assets, there are two criteria, which is the first one of the entity's business model for managing the financial assets, and the second is the cash flows characteristic of the financial assets. Theories on the development MFRS 9 financial instrument. The first, inductive approach. In the induction process, the researcher as an observer should honestly, without any prejudgments and biases, and with an impartial mind, register what they observe. By referring to the data, MFRS 9 is more particular to come out with greater perspective to produce report. The classification and measurement principles of financial liabilities in MFRS 139 are mostly retained. The only change is that entity is required to present fair value changes arising from its own credit risk in OCI and not profit or loss. The second one is positive theory. The positive theory try to make good prediction of real-world events and translate them to accounting transactions. And the positive theory try to explain the predict, which is actions such as which accounting policies firm will choose and how firms will react to newly proposed accounting standards. MFRS 9 can see as a contract or policy. It fulfills companies' expectation by improving the flexibility and the requirement of timing. Credit managers has low incentives to choose to account standards which report higher earnings is somehow true as suggested by the finding of the MFRS 9. Because of the adoption of MFRS 9 requirements relating to the presentation of gains and loss on financial liabilities presented at fair value only impacts how such gains and losses are presented but not the amount itself. The third one is sociological approach. The sociological approach assumes the existence of established social values that may be used as criteria for the determination of accounting theory, and the MFRS 9 improves the decision and usefulness of financial statements by better aligning hedge accounting with the risk management activities of an entity. It makes some fundamental changes to the existing requirement by the removing or amending some of the key provisions and the rules within MFRS 139. The new requirements will provide more flexibility and allow entities to apply hedge accounting where they would not be able to do under the current MFRS 139 requirements. This is an opportunity for corporate treasurers and the boards to review their current hedging strategies and accounting, and to consider whether they continue to be optimal in view of the new accounting regime.
The main parties involved in development MFRS 9 financial instrument. First of all, MFRS 9 adopts the same financial reporting standards as IFRS 9, which deals with the accounting treatment of financial instruments and consists of three parts: classification and measurement of financial instrument, impairment, and hedge accounting of financial assets. It has replaced the early financial instrument, which called IAS 39, since the 1st January 2018. So, IFRS 9 is a joint project between the International Accounting Standard Board, which is IASB, and the Financial Accounting Standard Board, FASB. Due to the 2008 financial crisis, the Board of Directors decided to revise the accounting standards for its financial instrument to address the serious shortcomings caused by the financial crisis. The limitation of MFRS 9 financial instruments. As the global financial crisis exposed many problems with IFRS 9's predecessors, IAS 39, it was viewed as a complex, challenging to implement, inflexible, and confusing to investors in its treatment and reporting of risk management. Therefore, IFRS 9 sees a general shift from a prescriptive to a principle-based approach, change to the way financial assets are classified and measured based on their nature and how they are managed, change to the impairment model based on expected rather than incurred credit losses, and a move to hedge accounting guidelines that are less rigid. Adopting the new ECL, the expected credit loss model, will require companies to consider the multiple probability-weighted scenarios and macroeconomic factors in order to apply a forward-looking approach. Credit losses will be recognized earlier from the point a loan is issued and will be based on the expectations of losses over the life of the instrument. Equally as important, the ECL calculations will require significant management judgment, which must be supported by enhanced disclosure of asset quality, provisioning policies, and performance ratios.
Basis of verification of MFRS 9 financial instruments. There are two bases for theory verification of MFRS 9, which is the first one is dogmatic basis. This basis is used when we believe in a statement because of confidence in the person or group issuing the statement. The statement of MFRS 9 have been made by the person who has the authority, which is the MASB. We simply accept and follow the standards because we believe that the MASB has gone through all of the standards to make sure that the standards are reliable and not biased. In addition, many users of financial statements and other interest parties told the IASB that the requirements in the financial instruments were difficult to understand, apply, and interpret by themselves. They urged the IASB to develop a new standard for the financial reporting of financial instruments that was principle basis and less complex for them to better understand it. Next, MFRS 9 is the scientific basis. Scientific basis means that we verify the statements through some testing, research, experimentation, and others. The statements are supported with empirical evidence, and the statements are believed because of the logical relationship of the terms and the objective. This basis was formulated to overcome the weaknesses of dogmatic and a self-evident basis. For example, MFRS 9 required to make trade receivable at initial recognition, which is an entity shall measure a financial asset or financial liability at its fair value plus or minus in case of a financial asset or financial liability not a fair value through profit or loss. Transaction costs that are directly attributable to the acquisition or issue of the financial asset or financial liability. Hence, through this measurement, this can verify the statement with the evidence to support the statements. The nature of MFRS 9 financial instruments. MFRS 9 financial instrument is a principle-based accounting because an entity is required to prepare and categorize the financial instrument as set out by the Malaysian Accounting Standard Board, MASB, whose standards were generally principle-based. These standards are issued by the MASB through adopting International Financial Reporting Standard (IFRS) as issued by the IASB. Moreover, it was stated that the largest difference between the US GAAP and IFRS, or in Malaysia we use MFRS, is that MFRS is principle-based while the GAAP is rule-based. The rule-based framework are more rigid and allow less room for interpretation, while a principle-based framework allows for a difference of interpretation. In addition, MFRS 9 builds on the principle-based classification models, which consider the business model for managing the financial asset.
Next, we move on to the suggestion or recommendation to overcome the limitation. For the first point is that develop approach plan or time frame. Developed plan must fulfill the 5 requirements: accessible, clear, specific, precise, and accurate. Just a brief one on accessible is that to be accessible, a plan must provide the needed information so that you can find what exactly information needed. If data are not complete and unmistakable clear, the information cannot be used with confidence. Next, a specific plan identifies what will be done, when, by whom, and what cost. Precision is a matter of relating the unit of measure to the total magnitude of the measurement. And last one is accurate. A principal concern of the planning process is producing plans with predictable accuracy. Time frame is essentially about planning for the future in the medium and long term. Yes, planning must provide with sufficient time to fulfill the managerial commitment involved. There is even a specific way to measure such plan. The long-range goals or strategic plans are of 5 or more years. Intermediate-range tactical plans last 1 to 5 years. And short-range operational action and contingency plans last 1 year or less. Next point, identify new policy, key data, and process requirement. The new policies or process prescribe the criteria for selecting and changing accounting policies together with the process treatment and disclosure. This is intended to enhance the relevance and reliability of an organization's financial statements and the comparability of those financial statements over time and with the financial statement of other entities. Disclosure requirements for accounting policy except those for changes in accounting policy are set out in MFRS 9. For next point, plan, development, and implementation activities. An action plan describes the way the organization will meet its objectives through detailed action steps that describe how and when this step will be taken. Each action step or changes to be sought should include the following information: what actions or change will occur, who will carry out these changes, by when they will take place, and for how long, what resources, example like money, staff, are needed to carry out this change, and last, communication, to who should the information be disclosed. And the last one, build MFRS, measurement, valuation, and disclosure models, determining class of financial instrument and distinguish instrument measure. Is it either at the amortization cost or measure either it was measured at fair value.